Hello everyone, my name is Mr. J.M. Kimani, your lecturer in Management Accounting. Welcome to Lesson 5 of Budgeting and Budgetary Control topic. Lesson 5 will feature the master budget. So master budget will have what you call functional budgets as well as the income and balance sheet. Now the question reads, Dreamwheel Limited is in the process of reviewing its master budget for the 6 months ending 31st of December 2012. The statement of financial position for the year ended 30th of June 2012 is as follows. There is the cost, depreciation, and net book value. The amounts are shillings in thousands. Fixed assets 140,000, 14,000 and 126,000 respectively. Current assets stock 25,000, trade debtors 24,600, bank 3,000, total is 52,600. Current liabilities trade creditors 25,000, other creditors 9,000, total 34,000. Net current assets 18,600, total assets 144,600. Capital and reserves, share capital 100,000, profit and loss account 44,600, total capital and reserves 144,600. The budget committee has provided the following information for the period ending 31st of December 2012. Sales units, purchases shillings in thousands, wages and salaries shillings in thousands, and overheads shillings in thousands. May 4,000, 12,000, 8,000 and 7,000 respectively. June 4,200, 13,000, 8,000, 7,000 respectively. July 4,500, 14,000, 8,000, 7,000 respectively. August 4,600, 18,000, 10,000, 7,000 respectively. September 4,800, 16,000, 10,000, 7,000 respectively. October 5,000, 14,000, 10,000, 8,000 respectively. November 3,800, 12,000, 12,000, 8,000 respectively. And finally December 3,000, 12,000, 12,000 and 8,000 respectively. Additional information number 1, the selling price from May 2012 to September 2012 was shillings 6,000 per unit. The price increased to shillings 8,000 per unit from October 2012. Number 2, 50% of sales are paid in cash and 50% are sold on credit. Number 3, credit sales are paid 2 months after sale. Number 4, purchases are paid 2 months after the month of purchase. Number 5, wages and salaries are paid 75% in the month in which they are incurred and 25% in the following month. 6, overheads are paid 1 month in arrears. 7, fixed assets worth shillings 30 million were purchased during the month of October 2012. The amount is to be paid in 3 equal monthly installments commencing 1st of January 2013. Number 8, depreciation on fixed assets is at the rate of 10% per annum on a straight line basis. A full year's depreciation is provided for fixed assets owned as at that 1st of December every year. Number 9, shares worth shillings 20 million were issued through the stock exchange during the month of September 2012. Number 10, the value of closing stock as at 1st of July 2012 was equal to the previous 2 months purchases. As at that 1st of December 2012, the value of the stock was equal to the preceding 3 months purchases. 11, dividends worth shillings 10 million relating to year 2012 will be paid to shareholders during the month of December 2012. Required A, revised cash budget for the 6 months period ending 31st of December 2012. Number B, revised budgeted income statement for the 6 months a period ending 31st of December 2012. And C, revised budgeted statement of financial position for the 6 months period ending 31st of December 2012. End of the question. Now, this question is about preparing the income statement and the balance sheet, but first of all, the cash budget. The cash budget will require some workings like the debtors collection schedule, and we may require about the purchases or and sales. So first of all, for us to get the sales, we require to have a sales budget because the price is changing, though the units have been provided to us. So we are going to have these workings. We'll have the sales budget. Sales budget. So we have details. These are workings we're doing, details. We have the months of May, June, July, August, September, October, November, and even December. So these are the months we expect. So we are going to have the units. The units given there, we have 4,000, 4,200, 4,500, 4,600, 4,800, 5,000, 3,800, 3,000. Then we can have the selling price per unit. We have been told in note number 1 that the price has been 6,000 since May. So 6,000, each at 6,000, each at 6,000. But the price changed. The price changed since from October. So this is still each at 6,000. This is now each at changed to 8,000. Each at 8,000. Each at 8,000. So this now will enable us get the sales in shillings. And this being the sales in shillings, we are going to have it as in thousands. So in thousands. So as we multiply, 4,000 times 6, this is 24,000. The figures are in thousands. This is 4,200 times 6. This is 4,200 times 6. This is 25,200. 4,500 times 6. This is 27,000. 4,600 times 6. This is 27,600. 4,800 times 6. This is 28,800. Then you have 5,000 times 8. This is 40,000. 3,800 times 8. This is 3,400. And you have 3,000 times 8. This is 24,000. So with that now we have managed to get what we call the sales budget. Sales budget. But again, because we were told about when this is to be paid, So we can attach with what we call the debtors collection schedule. So we can have here debtors collection schedule. So still using the same kind of columns. The same columns. Now, the debtors collection schedule, you are told that 50% is to be paid the same month. In note number 2, 50% of sales are paid in cash and 50 is in credit. And number 3, credit sales are paid 2 months after sale. So we are going to have, this is, let me call it as cash. This is cash is 50%, then credit 50%. So this means half. So half to be paid the same month. So it is 0.5 times 24,000, which is of course is 12,000. So 12,000 to be paid there. This is 0.5 times 25,200. This is 12,600. 0.5 times 27,000. This is 13,500. 0.5 times 27,600. This is 13,800. 0.5 times 28,800. This is 14,400. 0.5 times 40,000, which is 20,000. 0.5 times 30,400, which is 15,200. And 0.5 times 24,000, which is 12,000. Now that is to be collected the same month, But the credit is to be paid the following after 2 months, meaning the other half of the month of May, which is 12, this is to be collected after 2 months. So we expect this one to be collected here, which is the month of July. So we push this 12,000, the other half, which is to be collected there, 12,600 to be collected after 2 months, 13,500 to be collected after 2 months, 13,800 after 2 months, 14,400 after 2 months, and you have 20,000 after 2 months. Meaning, when you come to the debtors, if I have here a working on debtors, I'll have the debtors for the month of November, which is this half. You know, for November, we still have some 15,200 that has not been collected. And for December, I'll have actually this half of 12,000 not collected. So that is what we have as far as debtors are concerned. And that's also, we can have the receipts. We can have the receipts. And these receipts, we look at the months we have been asked. We have been asked 6 months to December. So 6 months means we want July up to December. So as we add this, we'll find out that this is already 25,500. This is already 26,400. This is 27,900. This is 33,800. This is 29,600, and this is 32,000. So that is now the collection that we expect from the debtors within that period, and therefore we are through. As far as the cash, the sales budget, and the debtors collection schedule are concerned, we are through these collections or collection. That's all as a working. When you come to others like the creditors, we don't expect to have any working, because for purchases which are to be paid 2 months, all of them to be paid after 2 months. The question is, do you have purchases? Yes, I can see purchases. So we do have purchases. So you have no problem of determining purchases. I do not see any other apart from the creditors, that we can say creditors, we have, if you're going to pay, we're going to have some balance of creditors. But all in all, let's come up with the cash budget so that at least we are able to. So let me have my debtors. I transfer my debtors. So this is November and December. So I'm having 15,200 and I'm having 12,000. Now this will be the debtors at the end of. This is debtors, this is balance carried down at the end of this period. But we do have debtors at the beginning of the period. The debtors we had at the beginning of July are debtors for the month of May and April and June, which have already been received. For May, it has been received this 12,000. For June, it has been received this 12,600. And that's why, if you look at these two figures here, these were the debtors, not exactly these amounts, but similar to these amounts, which are these ones. They make our debtors, which is 24,600. If you look at the balance sheet, debtors are 24,600, which is very true. That is already cleared. So you have new balance of debtors, which is this amount, which is 27,200. We have creditors. Creditors, this is a balance carried down. Creditors balance carried down. So we do have, we are not told when we are to pay, but at least we are told information number 4, purchases are paid 2 months after the month of purchase. So we expect the purchases for the month of May and June to be paid. And May and June, if you look at purchases, 25,000, which is equivalent to the creditors. So we only expect the month of November and December. This is November and December purchases will not have been cleared or paid. So that means as I look at the November, purchases is 12,000, December 12,000. So meaning my new creditors will be 24,000, sorry. This is my new balance of creditors at the end of this period. And that is it. So we have others, wages and all that, but I would like to indicate this as I am working with the cash budget. So let's have the cash budget here. So you have cash budget for the 6 months. So we have details. We have July, August, September, October, November, and December. November and December. So this is the cash budget. The cash budget that we expect. That way, that's all. So let's have the opening balance. So this is balance brought forward. Then you have receipts. The receipts, we can start from debtors. We have done a working on the debtors collection schedule. So for the month of July, we expect 25,500, 26,400, 27,900, 33,800, 29,600, and finally we have 32,000. That is what you have as far as debtors are concerned. Then looking at the question whether we have any other receipts, we may be issuing some shares. For example, information number 1, we are through, and 2, 3. Then we have information number 4, 5, 6, 7. All those are payments. Number 8, depreciation. Number 9, shares worth 20 billion were issued through the stock exchange during the month of September. So you're going to have here from shares, the month of September, we shall receive an amount of 20 million, which is 20,000. The figures are in thousands, so this is shillings in thousands. Dash, dash, dash. That is number 9. 10 and 11 is about dividends to be paid. So that's all. We don't have any other cash receipts. That is all. So that now we can have the payments. Payments we can have to creditors or suppliers. So we are paying the creditors. Remember the payment. The payment for the month, we are paying 2 months, 2 months later. So for the month of May, purchases are 12,000 to be paid 2 months, which is the month of July. The payment for June is 13,000 to be paid in this month. But the payment for July, so July is 14,000 to be paid here. August payment of 18,000 to be paid here. September payment of 16,000 to be paid here. October payment of 14,000 to be paid here. While our November and December I have already indicated here as creditors. So we are going to have that as non-payment and by the end of the period. That is actually I've done note number 1, number 2, number 3, now number 4 I've done. Number 5 is that wages and salaries are paid 75% in the month in which they are incurred, 25% the following month. So if I put here wages and salaries, I'll have 75% and I have 25%. So that at least we're able to show that 75% to be paid the same month. So this is the quarter. So when it comes to the wages, we have wages for the month of July. July is 8,000. 75% of that is 6,000 because half is 4,000 and the quarter is 2,000. So this is 6,000. And therefore, the other part to be paid here, 2,000, which is a quarter to be paid there. So 6,000 and 2,000. Then the August. August is 10,000. This is 7,500 to be paid here, but 25% to be paid the following month. I'm pushing 25% the following month. Same case with the month of September, 7,500 to be paid here, but 25% to be paid 1 month after. Same case to October. October we are having 10,000, so 7,500 paid here, 2,500 paid here. And then you have November. November we have 12,000. 12,000 are the quarter. Quarter of this is actually 3,000. So 9,000 to be paid here and the 3,000 to be paid in December. But when we come to December, the salaries are 12,000, 9,000 to be paid here, and we have the balance of 3,000 to be paid later. So we have here, we can talk of accruals. This is accruals as a working. Now, if you look at accruals as a working, in the balance sheet, we are having other creditors. These are other creditors. So we have other creditors of 9,000. So we have balance brought forward 9,000. So first of all, we have wages. This is wages for the month of June. Wages for June, we are paying it because when wages of June, we paid 75% in June, but 25% to be paid in July. So wages of June are 8,000, so 2,000 to be paid in this month. So therefore, we have cleared 2,000. So we need to exempt 2,000 from there. And we do have others like we have been told about overheads. So we have overheads also. So overheads, as we come and record here, let's say overheads. We have been told that overheads in the information number 6, that overheads are paid 1 month in arrear, meaning the overheads of June were arrears. Overheads of June, which are 7,000, were actually, this is was in arrears. So therefore, we subtract it. So that means we are able to actually pay all. And let me just put here, 7,000 is the overheads for the month of June. But remember, we are having now the new one. So we have the balance carried down, which involve wages for December, which is 3,000. Remember, December we have received only 9,000, but out of 12,000, we have 3,000 is not paid in December. So therefore, we are going to have it there. Then we have overheads. June we have paid. July overheads. July overheads is 7,000. We pay here 7,000. August we pay 7,000 also here. October, not October, but I mean September. September is 7,000 to be paid in October. October is 8,000 to be paid in November. And November, 8,000 to be paid in December. And December will not be paid, and therefore we'll have it here as overheads, as accrual. So we have overheads. This is the month of December. It is 8,000. That means we are going to have the balance, which is actually now the 11,000. Not anymore 9, because 9 has already been cleared. So we are going to have now this 11,000 as our new accrual balance at the end of the period. That's all about wages and overheads. Information number 5 and 6. Number 7 is about fixed assets worth 30 million we are purchased during the month of October, but the payment was to be made from January 2013. This is 2012. The payment will be made after. So we do have that as a liability. We have creditor for fixed assets. This is 20 million or 30 million. This is 30 million, yeah. So 30,000. Let me just put that 1,000. So this is going to be recorded at the end of the period because we have not yet actually paid this 30,000 or 30 million. So therefore, it become a liability at the end of the period. So we are going to have that in our balance sheet. Depreciation does not involve any cash. Number 9 is shares we have done. Number 10 is the value of closing stock. This one, we have done it, and actually is going to appear in our income statement. We don't require it here. We have done the purchases. Number 11 is dividends worth 10 million for the year 2012 will be paid in December. So we're going to have here dividends. Dividends will be paid in the month of December. And how much is it? It's 10 million, meaning 10,000. Will be paid in that month. That's all. And that's the end of the information, plus also these forecast. Sales we have through, purchase we are through, wages we are through, overheads we are through. Our balance sheet, we don't have any current assets or liability, we have been told. Like we have, we don't have any of accrual not recorded. We don't have any other prepayment. So we are through with that. So we just need to add the payments here. And then we can have the closing balance of cash here. So the balance carried down. So let's record first of all the payments. There's nothing that payment is remaining. So we can just add the payments. We don't have any overdraft. So just this is 12,000 plus 6 plus 2 plus 7. This is 27,000 payment. This is 13 plus 7.5 plus 2 plus 7. This is 29,500. 14 plus 7.5 plus 2.5 plus 7. This is giving us 31,000. Then you have 18 plus 7.5 plus 2.5 plus 7. This is giving us 35,000. 16 plus 9 plus 2.5 plus 8. This is 35,500. And lastly, we have 14 plus 9 plus 3 plus 8 plus 10. This is giving us 44,000. Then now we can balance. Starting with the July, what do we have as the opening balance of cash? Looking at the question, we have in the balance sheet, which was made up to 30th of June, the cash balance in the bank is 3,000 without any overdraft. So 3,000 is actually our opening balance for July. So 3,000 here. So this becomes 28,500. And 28,500, when you actually subtract 28,500, if you subtract now this 27,000, this actually you get 1,500 as our closing balance, which we begin with 1,500 here. We add to this, we get 27,900. 27,900 minus 29,500. That means we must take an overdraft of 1,600 overdraft, which we are going to make payment here, as we already have it as a negative, so is a to be paid. Then we add to 27,900 and we add to 20,000. So we are able to clear the overdraft and we remain with the 46,300, which if you pay 31,000, we still remain with good money of 15,300, which will begin with it here, 15,300, which plus 33,800. This is actually 49,100. Then minus 35,000. This is actually giving us 14,100, which we begin with 14,100 here. When we add to 29,600, this will give us 43,700. When we less 35,500, this is going to we're going to remain with 8,200, which if we bring it here 8,200, you add to 32,000, you get 4,200. If you subtract 44,000, we remain with 3,800 as overdrafts. So we remain with overdraft at the end of the period. That's our projection. We are going to borrow an overdraft at the end of this year of 3,800,000. That's all we have as far as the cash budget is concerned. Then we require to have now the income statement. And for income statement, as far as we have sales in total, we have now the only item we have not dealt with is the depreciation. In note number 8, it is 10% per annum on a straight line basis. And we are told that a full year depreciation is provided. So we are going to work out the depreciation when we come to the income statement. So what we require actually is the sales. Sales for the month of July up to December. We require to add this as a working as we come to the income statement. So let me just record them here because I need to reserve these figures. So we have sales for July is 27,000. We have 27,600. We have 28,800. We have 40,000. We have 30,400. And we have 24,000. These are the sales we have for the 6 months. So we require them as much as we require the all these. So let's have the income statement. Income statement. I don't require anything else there. I already require the sales, so I'm okay with that. So you want the income statement for 6 months. So you have part B. This being the part A. Part B is budgeted income statement. This will begin, of course, with the sales. Sales for July. Remember, this one is July to December. So when I add, because I had already reserved the figures there, so I'm having 27,000 plus 27,600 plus 28,800 plus 40,000 plus 30,400 plus 24,000. So my sales, I'll be able to get total sales. Doesn't matter whether we have received the money or not. 27,000 plus 27,600 plus 28,800 plus 40,000 plus 30,400 plus 24,000 equals to 177,800. Then we don't have any returns, so we can just subtract less cost of sales. The cost of sales is made up of the opening stock. Our opening stock has already been provided in the balance sheet, which is actually the closing stock in the balance sheet. The closing stock in the balance sheet is 25,000. We put it here, 25,000. Then you can have the purchases. Purchases for the month of July to December, if you add them, month of July to December, if you add them, we'll discover that we have purchases of July is 14. So if you add, so you're having 14 plus August is 18 plus September is 16 plus October is 14 plus 12 for November and 12 for December. So this is going to give us a total of what if we add? So this is going to give us 14 plus 18 plus 16 plus 14 plus 12 plus 12. This is giving us 86,000 as the purchases. Then we go to the closing stock. Now, the closing stock, this one actually depends on what you call the production or either the purchases budget, where we require to look at the units that we sold or the sales, and we compare with the opening and the purchases. For example, we have actually the opening stock, and you have been told information number 10, the value of closing stock as at 1st July 2012 was equal to the previous 2 months, which is 2 months purchases. So we are going to have here the November and December. So November plus December purchases. So if I just, because you have the instruction, I can just add here. The November is 12,000, December is 12,000 purchases. So the closing stock is 24. 24 is our closing stock, and therefore we have been told already that as at that 1st of December 2012, the value of stock was equal to the preceding. No. Sorry for that. Number 10 reads that the value of closing stock So closing stock, you're told in note number 10 that the value of closing stock as at 1st of July 2011 was equal to the previous 2 months purchases, which of course it was May and June. And May and June is 12 and 13, which is 25, which is okay. Then you're told that as at that 1st of December 2012, the value of stock was equal to the preceding 3 months of purchases. 3 months of purchases means you take the month of October, which is 14, plus the month of November 12, the month of December is 12. So those are the 3 months. So when you add this is actually going to be 24. 24 plus 14, that is 38, which is to be deducted, and that is it. So when you work out this, we'll find that we have 25 plus 86, then minus 38. So you have 73 here. Then when you subtract, we get what we call the gross profit. This is gross profit, which is 177.8 minus the 73. You get the 104,800. We don't have any income like the discount received. We just go straight to the expenses. We say less expenses. Our expenses would include the following. So I want to transfer these amounts. We have the debtors, which is 27. So I can reserve my debtors here just because I don't want to forget these. So the debtors we have already seen. They are 27,200. I have seen creditors. Creditors are 24,000. I have seen accruals. Accruals 11,000. And there is creditors for fixed assets, which I have 30,000. So I want to reserve this space, and therefore I would rather reserve that. This is to be reserved. So let me erase now this. So I want this space for the income statement. So the first expense I need, as per the forecast, I can see I need the wages. So we can have here wages and salaries. So when we add these wages and salaries for this is July to December, whether it's paid or not, when you add this, we'll get the wages. July 8,000, August 10,000, September 10, October 10, that is already 30, plus November and December is 12, which is 24. This will give you 62,000. This is wages salaries is 62,000. Then after wages, we have overheads. Still July to December, which when I add, I can get July is 7,000 up to September. Those are 3. So 7 times 3, that's 21. Then I have October to December is 8,000. So 8,000 times 3 is actually 24. So I'm having 45,000. As the overheads. We have no other expenses as like interest. We don't have interest, but at least we have the depreciation. So we have depreciation. Now depreciation, we are told that we are to charge 10% per annum on straight line basis. So we are going to have 10%. The asset we have in the balance sheet cost is 140,000. We add the new one. With the new one, we actually purchased the new one. We purchased the new one in the month of October, but it's going to be charged for the whole, in fact, the whole year, because you're told for a whole year. But first of all, we are going to work with these 6 months, July to December. So this will be multiplied by 6 months out of 12. We work on the 6 months first. So this is going to be on 170. So 10% times 170,000, which is 17,000. Then divide by 2 because it is that's a whole year. We divide by 2. This is 8,500. So that is it, and they don't have any other expenditure to subtract there or to offset there. I've dealt with everything. There is no commission, wages, overheads, dividends later. I think I'm through. So I can subtract this and get my net profit. This is net profit for the period. The period is 6 months. So when I subtract, I'll have 104,800. I subtract 62,000. I subtract 45,000. I subtract 8,500. I'll get a negative 10,700 as our loss. So it is a net loss for the period. Then I add the retained profit. This is profit that we have retained up to June of this year. The profit retained is in the balance sheet, which is actually 44,600. Let me put it here first of all. 44,600 because I need to adjust. There is this depreciation of the new assets that had not been charged because it's new in this period, though we have a policy of charging a full year depreciation. So you're going to say here less. So depreciation brought forward 10% of 30,000 times 6/12. This is for the 6 months that are already passed that are not in this period. So you'll be having, this is 3,000 multiplied by 6/12, which is divided by 2. This is actually 1,500. So that now you can transfer the balance after adjusting, which is actually 43,100. Then we can less dividends. Dividends actually are 10,000. We can less 10,000 here, and that is it. So the retained earnings here or profit is now the balance, which if we take the negative 10,700, we add the 43,100, and we less 10,000. This is giving us a 22,400 retention. That is the retained profit, and that is it. Then the final one is now the balance sheet. We are through with that. When you come to the balance sheet, so I need to have this space. I already have reserved what I need, including my cash balance, which is an overdraft. I have also a bank overdraft. So bank OD of 3,800. These are items that I require in my balance sheet, and therefore I have reserved them. So I need to have this space for the balance sheet. I now put everything in place. So this is a statement of financial position. So let's have here part C. This is budgeted statement of financial position, which is the balance sheet, which I need to have my non-current assets, where I'm having the assets as follows. This, we already have non-current assets. We have the cost of the non-current assets. We have 140,000. We add the new asset of 30,000. This is going to give us 170,000 is the cost of the asset. Then we have accumulated depreciation. So we do have what we have up there is 14,000 in the balance sheet. This is the previous depreciation of the other periods. But this year, we have charged depreciation. We have charged this 8,500 and even this 1,500 that we have adjusted our profit. So you have charged actually 10,000. So this means we are charging 24,000 as the depreciation. So in that case, we can now say that our net book value is actually 146,000. 146,000 is our net book value. We don't have any other adjustment to the non-current assets. We can have current current assets, we do have the closing stock, which closing stock we have it here already. It is 38,000, so 38,000. We have the trade debtors, which you have done it here. It is 27,200. We have the bank. Bank is an overdraft, so it won't be here. We don't have any other current asset, so we can add these two. So this will give us 65,200. So which if we add together total assets, this will give us 211,200. That's the first balancing figure, 211,200. Then you can have the financed by. We do have the share capital. We have share capital. We have actually issued more shares worth 20 million. So the previous share capital we had was 100,000. We add 20,000. Total is going to be 120,000 share capital. We have the retained profit, which you have just determined 22,400. Then we don't have any. Do we have debentures? We didn't issue debentures, so that is all. We don't have debentures there. So we can come to the current assets. No, current liabilities. We do have the trade creditors, which trade creditors 24,000. We do have the creditors for fixed assets, which we have this one, 30,000 for fixed assets. We have the accruals. We have 11,000. 11,000, and we have the last one, which is bank overdraft. So bank overdraft, OD, which is actually 3,800. And looking at the format we have, we don't have any other item that is left, and therefore we expect that one to be the final that you can balance. So when I add this, I'll have 24,000 plus 30,000 plus 11,000 plus 3,800. I get the 68,800. That when I balance this, it should balance with this first balancing, which is plus 22,400 plus 120,000. It is 211,200. And therefore it has balanced, and that is what we call the balance sheet. It has to balance. When it has balanced with a lot of struggle, you normally write, I normally tell my students, quite hardly done. But when it is balanced without struggle, then it is quite easily done. So quite easily done is what I take, because I didn't have any struggle determining or getting the balance. I have traced each and every item that requires to appear in the balance sheet and the income statement. Everything has been in place, and therefore for me is quite easily done. But there are cases where you may struggle to find the statement balancing, and therefore it would be hardly done. For me, it's quite easily done. That's all about the question, and that question has actually ensured that we revise still the functional budgets, cash budget, that is, and the income statement and the balance sheet. That's all about the master budget, and that's all about the lesson 5. So our lesson 6 shall actually be the flexible budget and fixed budget. And that will be all about that part of the budgeting. So let's meet in lesson 6. But for now, please do more exercise. Still visit more lectures on the same website, and you get more exposed. I wish you all the best. Thank you, everyone.